Joining us right now with more on what we can expect from the Fed is Roger Ferguson. Of course, he is the former vice chairman of the Federal Reserve. He's also the former CEO of TIAA and a CNBC contributor. And Roger, let's just talk this through. It was off to the races for the markets on Friday on the suggestion that maybe the Fed pivot is coming come December. What do you think? Is that the right take on this? What is the Fed actually considering?
I think what the Fed is actually considering is 75 basis points the next meeting, pretty much baked in. Market understands that. I think depending on the data, 50 or 75 at the last meeting of the year, and then continuing with one or two more increases in the first part of next year. So I think the market was wrong to get off to the races, as you say, because I think once the Fed is done with hiking, it's also going to stay there for a very long time until inflation is conquered. So I think the market is misreading the Fed's intentions, even if the Fed does, slow down a little bit in terms of the pace at which it's raising rates.
Meaning that even if they stop, they're going to look around for a while and say, what's up? Have we actually defeated inflation before you can even sniff the idea of a rate cut?
I think that's right, and I think Chair Powell has said that. I think the market, has had moments of hopeful and optimistic behavior. Earlier in the summer, there was, of course, the, have we reached peak inflation? And then there was an earlier discussion of a pivot that died away with bad numbers, most recently in the CPI. So the pivot's back on the table in the market's minds, but I think they're losing track of the big picture, which is inflation is still running far too high for the Fed's comfort, and they are going to use their tools, primarily interest rates, to get inflation much closer to the 2% target and have a high degree of confidence that it's there before they even think of reducing rates.
How much market psychology goes into the Fed's discussions, or at least their thought process on what they're doing? By that, I mean, if the market gets excited and thinks, OK, this is a Fed pivot coming, does that in itself play into the experiment? Does it mess things up for Jay Powell, have him thinking we can't have them believing this good hope, so we're going to have to stay and continue to raise rates for a bit longer, or be more aggressive in the December meeting to send a message?
I think there's some focus on the market, not so much in the psychology, since the way you're talking about it, Becky, but in the fact that, as Chair Powell and others have said, monetary policy works through what's called, financial conditions and tightening of financial conditions. And one of those tools for so-called tightening the financial conditions is in the fact the equity markets. And so, equity market rallies mean a loosening of financial condition, means monetary policy is not being transmitted as much as the Fed would like. And so in that way, I think it does actually play in. So it's not so much a psychology game as it is the reality of monetary policy being made less effective when markets rally against the obvious intention of the Fed to keep financial conditions tight.
But fair to say that Chairman Powell and company looked at the market's reaction on Friday and were not pleased.
I think that's probably right. I know if I were sitting there, I would think, on the two separate issues. One is maybe they're not hearing us clearly, that, we're going to use our tools to get inflation under control. And secondly, they may be misinterpreting, stepping down from 75 basis points to 50 to maybe 25 as maybe a change in intention. And so if I were at the Fed, I'd be scratching my head a little bit as to, why it is so hard to keep equity markets understanding the intention, and do we have to make, stronger speeches as well as take stronger actions?